We've got CPI, PPI, and the FOMC jam-packed into this week's worth of trade, and I would certainly not expect markets to be quiet like they were last week, just stuck sideways in a balance range. So, let's do what we do best and round up all of the relevant data points to build a game plan into the upcoming week's worth of trade. As always, check out the links listed down below in the description, hit the thumbs up button, and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this past week, we're certainly dealing with a green-bodied doji, so although it would indicate some indecisiveness, it's not quite as bad as what we have in this example or in this example right here. Of course, the green bar represents that the close was over the opening print, so there's a small bullish edge, but of course, a lack of confidence in the upper wick and in the lower wick from both the buyers and sellers respectively. So maybe small bullish edge structurally, but location-wise, we certainly have on the bar-to-bar count a substantial higher low as well as a higher high, stacking up as a more definitive bullish data point. And also, if we throw in the context on the weekly time frame of this as the pattern that is breaking out, it's basically an ascending triangle that's breaking out here, that of course is also, quite frankly, an obvious bullish data point. So, where are we in the trend sequence and what can we afford? Can we look for a higher low pullback or should we be expecting continuation? We've got higher lows along the way and we've got higher highs to complement that, meaning that we are in an overall weekly uptrend sitting on a higher high, and thus the weekly chart can afford a pullback without falling from a weekly uptrend. In a picture perfect world, it would be a retest of the breakout point and then we would turn there for some kind of higher low, respecting the previous structure. What was once resistance can now potentially act as support. We know that we're well above our anchored view apps from the all-time high and October low, so let's skip right to our volume profile. The breakout point of the pattern is the high volume node, and once again that confluence would build the case that a pullback that respects that as support would be very reasonable on the weekly time frame. We can afford it because we're in an uptrend and we do find ourselves in the low volume void. The next overhead high volume node for resistance is just north of 440, not making the call that we go there in the coming weeks worth of trade, but overall the weekly time frame chart serves to say that we can see continuation due to the lack of volume resistance overhead, or we can pull back and look for support above 417.25 and be good to go, remaining in an uptrend. On the daily time frame chart, let's first evaluate the expected move. If you're not familiar with this study, check out the tutorial in the top right-hand corner. If we're contained by the upper bound, the number is 437 even, and that of course implies a big higher high. If we're contained by the lower bound, the number is 422.90, and from here to here, that of course implies a higher low. So expected move is bullish, and I also like the fact that the lower edge is confluence of support with the gap close from 2 weeks ago. If we think about daily trend, we know that we have lows, higher lows. We could still afford to pull back and find higher lows at the lower bound of the expected move. We'll talk about why this doesn't concern me in just a moment, but along the way, we've been getting highs, higher highs, higher highs, higher highs, and as of Friday's high of day, a brand new higher high. So very much so in a daily uptrend. Now, why am I not concerned with taking out the lows of the flag pattern just yet? Because this move, the last leg higher in the daily uptrend, was digested sideways via time and not lower via price. So if we do take out this set of lows at 426.50, it would still be okay to find a higher set of lows from here to here, respecting some of the breakout point, which was, or I should say led to, the gap up from 2 Fridays ago, right? So all things considered, bullish trend, and we can still afford a higher low pullback. Now, if we think about the candle structure and what unfolded on Friday, 2 interesting things take place. Clearly, just looking at the structure there, it's an inverted hammer. So you would think off the bat, okay, bear's kind of making a stand up towards the top there. Maybe we do see a pullback. But one thing I would just remind you is that Friday was technically a gap up out of the bull flag consolidation range. In the lower wick of Friday's bar, and we'll see this on the hourly in just a moment as well, we technically support off of the prior high of day and close above 429.25, the upper bound of the bull flag consolidation. It's a very nuanced point, but it is technically bullish from that perspective. I'm not making the call that we just straight shot into the upper edge of the expected move, but I do think that as long as we're above 429.25, there is a clear bullish edge in the market. Now, in last week's episode of the midweek market update, we talked about how 437 is really not that far away from a measured move perspective, and our rough eyeball test was like, maybe it gets there, maybe it doesn't. I'd like to be a little bit more precise in the weekend video and take out our actual fib tool to measure this, come in from the low to the high and then back to the anchor low of the consolidation, you'll notice that the 100% extension, aka the measured move, the flagpole stacked from the bottom of the flag, actually brings you north of 437. So I do think if the market remains bullish over 429.25, we can see that rotation to the upper edge of the weekly expected move and not necessarily be too far offside, so to speak, with a rotation that's larger than the expected move from the pattern. Let's take a look at the hourly time frame chart here. Now that we kind of understand the daily context being definitely more bullish than bearish, I think it's all going to boil down to the flag range. I mean, quite simply put, you can clearly see very well respected technical levels even from the Friday low. So 429.25 speaks for itself. The one concern as we open early on in the week is technically the lower high that formed intraday on the Friday session. So if we stay underneath that lower high in the early stages of Monday, that level, just to give you the number, is 430.50. If we're underneath that, then absolutely you could look for a breakdown underneath 429.25. But would I look to go short right here? Probably not. Because we are in a daily uptrend, I would want to see proof of a lower high back down in the range for then the rotation back towards the bottom at 426.50. That would set up the short early on in the coming week's worth of trade if we're going to play the downside more responsibly, in my estimation. Any consolidation up here is just bullish consolidation over 431.75. The top of Friday basically brings us towards that upper edge of the expected move. There's no structure coming off from the left until 437, right? So that's your upside. Now, the larger concern where the bears really start to build an edge is if we do see that full gap close. So don't get me wrong, something that does this is not friendly. This breakdown underneath 426.50, if it happens and the market is required to see that full retracement down towards this gap fill reversal, the threat on the higher time frames, on the daily time frame chart, you could envision how this is no good. Right? So I would say that there's an opportunity for a daily higher low here. That's the argument we were just making on the daily time frame chart. But the threat, of course, is then the lower high underneath 426.50, the bottom end of the flag range. So if we go here, you bet your bottom dollar, the market needs to recapture and get back into this range. Otherwise, we risk falling into a neutral trend and then a trend change for a stronger move in the downward direction. But it hasn't happened yet, and we're talking about things that may or may not happen in the future. These are the numbers and situations that you would need to be prepared with. So that's a part of the game plan, of course. A couple of pieces of confluence and supporting evidence, and then we'll get into our internals and so on. So first up, let's go ahead and throw on the anchored view app from the breakout point. This was from back here, right? And of course, where is that? It's providing confluence of support at the daily higher low zone, the gap fill reversal we just discussed at 422.90, lower bound of the expected move. And if we come in with the Fibonacci's from the low up to the high, where's your 38.2? It's technically the top of the gap. So this general area on the daily time frame, in my estimation, can still produce a daily higher low. It gets better than that, though. If we take this and edit it, let's just go ahead and briefly bring that up to 2023-0601 for the 1st of June. If you're using a month-to-date anchored view app, this was the first, right? And what you'll notice, it's also basically the low of this last leg higher that we were just discussing. It's confluence of support with 426.50. So building the case that even if we do get this lower high rotation, you should be looking for support at the bottom end of the bull flag range we just saw on the daily time frame. And if we do the same thing with the Fibonacci's from the low up to the high, where's your 38.2? It's basically sitting right there at the bottom end of the flag range, 426.50. Key support. As long as we're above that, the market is optimally bullish. Staying in that range, we'll look for continuation. If we start breaking down underneath, this, of course, is the threat that we just talked about in detail. Let's take a look at some supporting evidence now. Market internals are Exhibit A. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. Let's take a look at our volume flows on the week. Are they in or out? They're definitely in, but are they significant? The answer to that question is no. They did not breach or exceed 500 million in the upward direction. So if we're thinking about this as overall balance, it definitely has a bullish edge, but the break on Friday, not all that confident in it, especially considering that the individual day from Friday certainly had negative flows from the market and was nowhere near the positive inflow read of 300 million into the close there. Same thing can be said about the advanced decline line. Overall on the week, we never really approached trend lower zone down below. So it's not like we had bearish consolidation, but the breakout on Friday and the move over the top of the bull flag range, not really being confirmed by the advanced decline line. Same thing can be said about the ticks down below. It's not like we had big new money sellers hitting the tape at the exchange level. So the consolidation does strike me as healthy with a bullish edge. But just like if you remember from the Wednesday video, right, we were very skeptical about the sell-off on Wednesday. There was more of a downdraft in the markets on Wednesday with neutral tick readings, right? So we weren't believers there. Well, we can't just pick and choose where we want to believe. We probably shouldn't be big time believers of the move over the top of balance if the cumulative tick at the exchange level was actually pointing lower on the Friday session. So is it reasonable to be skeptical of the bull flag breakout just yet? Yes, but are we getting new money sellers? Not quite. Market profile is always Exhibit B. If you're not familiar with this screen, check out the tutorial in the top right-hand corner. A couple of very important takeaways here on Friday. Yes, the value area is lower, as is the point of control. Definitely more of a bearish data point and perhaps supports the idea that yes, we do break back down into the flag consolidation range. We also have a poor low on the Friday session that could use some repair, and we also have a poor high. So treat either of those two levels, Friday's high or low, as a weak area that should break if retested when and if on Monday we open inside of Friday's range. But beyond that, there's a very important nuance that took place on the Thursday session here that I need to point out to you. First and foremost, remember that Wednesday had an incredibly poor low. Instead of just 2 TPOs back to back, we actually had 3 flat across the bottom. Thursday sweeps those lows, and instead of finding rejections and price acceptance underneath the poor low, which stronger sellers would have done, we actually rotate towards the top of the range, right? That's the bullish bar on Thursday, with the point of control migrating higher with price, as did value area. So once again, if we fall back down into range, it's not the end of the world here. We're not seeing stronger evidence of new money sellers, but there are some deficiencies to be concerned with Friday's profile in particular. I just think that this nuance from the Wednesday and Thursday interaction, the failure underneath that poor low, is very, very telling, especially that after that happened, the point, like everything bullish happened into the close of Thursday, right? So overall, market profile, watch your Friday low, totally reasonable that we come back down into range, not really evidence of new money sellers though. Jumping back on over to the platform to evaluate the weekly performance of our sectors shows us that the XLY consumer discretionary led the pack this week, up 2.69%, which is bullish considering that it is a heavier weight risk on sector. However, just underneath we see the XLU. That's the utility sector, which is classically D for defensive, and a lighter weight sector, up 1.73%. So kind of confused posture up here at the top of the list. How about at the bottom? The XLP is down the most here. That's consumer staples, classically a D for defensive and lighter weight sector, down 0.53% on the week. But it's followed by the XLK, the heaviest weight risk on sector, technology of course, down 0.47%. So let's do a very quick exercise here just to illustrate that although this column may look confusing, the structural charts themselves could not be any clearer. Let's take a look at the XLY. Are we seeing leadership or are we seeing a laggard here? This is certainly exhibiting leadership, producing a big time higher high. Don't get me wrong, we'll do an individual analysis here in just a moment. Maybe there's an opportunity for a pullback, but in an overall daily uptrend, strong leadership. Let's take a look at utilities, which in theory should be a leader if it's at the top of the list. Does this chart look anything like what we just saw out of consumer discretionary? The answer has to objectively be no. XLY is trading somewhere out here in relationship to this prior pivot top, right? So utilities, they are still lagging, even though percent-wise, they are at the top of our list. And again, even if this produces an inverted head and shoulders and we break out over that neckline, retrace the thin structure, tag up to 68, it's not really threatening leadership just yet. At the bottom of the barrel, we were concerned about XLP versus XLK. Does this look like a laggard? The answer to that question has to be absolutely yes. 100% retracement sitting in bear flag consolidation. It doesn't look great. It's a laggard. It should look that way, right? Let's take a look at the XLK. How about this one? Does this look like a laggard? The answer to that question has to be 100% no. It's the exact opposite, right? Strong daily uptrend, strong push in the upward direction, sitting in bull flag consolidation. I don't really think that the posture is poor, and you would be misled if you're only looking at the percent change on the week. So let's get a little bit more granular. We'll do a speed round through the analysis. Once again, XLY, inverted hammer on Friday based on the Tesla gap up with the GM news. If we break down underneath the low of that bar, I would be looking for higher low opportunities to preserve the daily uptrend. 157.75, line in the sand is the gap fill reversal. 154.14 up above us. If we do see straight up continuation, I wouldn't really recommend chasing that, of course, but it would be bullish for markets. The highest structure we have is 166.75 XLU. We just talked about the inverted head and shoulders. I think it's a very realistic outcome for this week. Pulling back, supporting 65.80, breaking out 66.80, and then looking for the rotation into 68 through this thin structure from the breakdown. That would be bullish for markets. XLI, industrials, 8% for the market, right, in terms terms of the percent weight in the S&P. A little bit of like a 3-bar play. It's not technically a 3-bar play, but bull flag consolidation up here at the highs. If the hammer highs break, we're looking for a move over 103, tags 105. Bullish for markets, obviously, and even if we pull back, we want to see it remain above the midpoint of the balance. We have structure at $100.20. XLF Financials, this is the missing piece of the puzzle. It's been that way for a while. Here's the banking crisis when everything broke down. We're trying to produce a daily double bottom. If we can get above and stay above, we are above and we are staying above, 32.85, the neckline of that pattern, I do think that bullish odds increase for an opportunity, or at least an attempt, to retrace the banking crisis structure, right? That's thin structure on the way down. This is the missing link. If technology wants to take a breather, the AI mania is over. If consumer discretionary and Tesla need a break after that GM news, it's up to financials to continue to push this market in the upward direction if the SPY daily bull flag is going to have more strength behind it. So really watching this one this upcoming week at 32.85. Primarily, I just want to see the neckline hold. It doesn't have to break out, but in order to remain bullish on the market overall, I want financials to stay over 32.85. Next up is real estate, really lightweight sector, really much more to do with the wealth effect, sideways in this range. No concerns there. Communications, leadership, clear as day, right? And this certainly from a posture perspective speaks to risk on. It's sitting nicely up here at these highs in a strong weekly and daily uptrend. If it breaks this, we're looking for continuation. That's over 63.85. Next target, 66.25. If we just remain in consolidation, I think it's fine and healthy for markets. Only concerned with the XLC if we go for a larger test of 60 and then lower high underneath 62.15. That's the issue. Clearly, you can start to see your head and shoulders. Call it whatever pattern you want, but that's where the structure starts to change trend there. We're not there yet, but it is a potential threat if a deeper pullback does unfold. Weekly would still remain fine. Weekly would remain fine. XLB materials, really lightweight sector, not much to say about this. It's not exhibiting leadership, not really concerned with that. Same thing with energy in terms of utilities, right? Not exhibiting leadership. Sure, it's breaking this range. It's trying to hold support over 81. Upward rotation is going to help the market sort of remain bullish, but we shouldn't see it lead any breakouts. It's really going to come down to that XLF we were just talking about. Consumer staples, we saw this as being incredibly weak. Bear flag consolidation in play. Nothing to do in the midpoint of this flag range. You're going to be aggressive, or at least should be very skeptical about upside out of your SPY if this is breaking down and nothing else is moving in the upward direction. We're seeing just a pause everywhere else. If this breaks down, that would be a red flag. Obviously, taking out 74 is constructive through the thin structure. We already talked about the XLK. One thing I would note about the XLK, and this is important, so if you made it to this point, let me know in the comments section by saying something about the tech sector. But notice that the SPY broke out on Friday, right? The Tesla gap up really pushed the XLY, consumer discretionary, out of its range, but the XLK is still stuck. Technology is still stuck in the flag consolidation range. Inverted hammer off the top of that. I don't really think that the SPY wants to continue without the help of this getting up and over 167.65. Upper targets beyond that, there's a lot of room to run there, a lot. 175.85. Not calling for that into the coming weeks worth of trade, just pointing out that there's really not much stopping us in that upward direction. Deeper pullbacks, just like we talked about on the SPY daily, not the end of the world if we want to come back down here and tag that. We did this illustration on the Wednesday video, right? Where's trend? Could we technically afford to go all the way back to the trend line? Yes, and still be producing like a weekly higher low at that point. Gap fill reversal, 155. Again, not forecasting that we go here, just pointing out the overall leadership out of the tech sector and perhaps waiting for this balance to resolve to have an overly convicted move in the SPY. Last but certainly not least, XLV, second heaviest weighted sector by market cap for the S&P. It held up beautifully in our little zone down here over 129 roughly. We'll just round it off to. This is acting as a neutral data point. We don't want it falling off of a cliff, but remember, it is technically D for defensive. This one doesn't want to exhibit leadership, is it? The answer has to be no. Here's the sector ratio grid. If you're not familiar with this screen, check out the tutorial in the top right-hand corner on how to set it up. Overall, these charts really speak for themselves. This is a risk-on look. This is a neutral look that we just discussed out of healthcare. The XLF, if it's going to be a more improved bullish force for the market, wants to find a higher low and break the 50 SMA. The XLY, consumer discretionary, really speaks for itself. Clearly a risk-on indication. Closest tie to the XLK is your XLC for communications, still above an upward sloping 50 SMA, but we will acknowledge that it's flattening and pulling back, but in the overall context of an uptrend. The bottom four are the risk-off sectors. Are any of these looking like a threat right now? Staples, absolutely not. Utilities, absolutely not. Energy, absolutely not. Wealth effect, much more of the look and concern from real estate. If we take a look at the XLY over the XLP for growth versus value, this chart again, I mean, it speaks for itself. Look at what's going on here. Strong move in the upward direction, well above this prior pivot top from back here. There's nothing about this that really indicates a risk-off posture is coming from around the corner. Taking a look at the dollar, you can clearly see that we're still in bull flag consolidation, but as of the Thursday and Friday session, we're testing that 103.50, attempting to break it down as the market is moving higher. In theory, that's the proper relationship. The only concern right now is that if we take a look at something like the gold contract, oops, we need a slash in there for the futures, you're still well underneath that 2,000 mark, and we're not actually even attempting it on that Friday session or into the end of the week. So the gold contract saying pause, but right now the relationship between dollar and equities is actually in sync with lower dollar, higher equities into the remainder of last week. Let's take a look at something like our TNX, what's going on with the interest rates, and we'll talk much more about fundamentals in just a moment, but technically so far, we do have a break, retest, and attempt for an equal high break into the end of the week. So it's no surprise that the tech sector is starting to slow down a little bit as rates are rebounding off the top of the prior structure back here. Now, what happens on Tuesday and Wednesday is going to be extremely telling. Let's dive into it now. The Fed tracker tool is still showing higher odds of a pause in the next meeting, keeping the Fed funds rate at 500 to 525 basis points. Do remember also that Jerome Powell will be using the terminology skip in the next meeting and not pause to not give the market the wrong indication for what may happen around the corner, specifically noting that we are expecting one more rate hike into the end of sort of summer here, early fall, bringing the terminal rate up by another 25 basis points and then starting aggressive rate cuts into the back half of 2023. Some interesting things that I want to point out here. Why did the market rally on the Thursday session, even though the jobs and unemployment claims came in higher than the forecast, right? We've been kind of thinking that good news is good news and bad news is bad news. Well, as of right now, under the assumption that the Fed is going to quote unquote skip in the next meeting, this is an indication that the skip may actually lead to a pause. And instead of going back here and seeing one more rate hike, if the jobs data does start to deteriorate, if more people are becoming unemployed, maybe the Fed does actually keep a pause here and doesn't come in with that last rate hike. Now, this is all subject to change dramatically because if we go forward into this week, here is the big fundamental calendar. It's absolutely loaded. On Tuesday morning at 8:30, we will be getting CPI month over month, year over year, as well as the core readings as well. That's at 8:30, and we will be live together on the pre-market prep. Keep in mind that we're still well above the Fed's target of 2%, right? We want 2% core inflation year over year, and we're not even close. We're still more than double that. The forecast is for 4.1. Remember in the last reading, we got a 4.9, which was technically underneath the forecast, but the forecast was 5. The forecast was 5. We only came in under expectations by 0.1%. I don't really think that the market wants to see that again. If we come in with big misses out of CPI, perhaps that extra rate hike does remain on the table. Then, of course, all the cards will be on the table Wednesday, June 14th, 2 p.m. That's when Jerome Powell comes out. We will be getting a new SEP, Statement of Economic Projections, and there should be some valuable insights in that. We'll do a breakdown Wednesday after the close, of course. Then the infamous press conference from Powell at 2:30 is when we classically see a lot of volatility. We'll see how all of these things come out. We will continue to update you on the channel here. There's no sense in really trying to predict what will happen with them. Let's wait. Let's respond accordingly. How about some risk appetite charts? Clearly no flight to safety trade taking place in the TLT versus the S&P. This speaks to a more bullish risk sentiment down below. If we take a look at different duration bonds, we are still on a small uptrend here and in here, but just notice that we have not yet produced a higher high out of this range and not yet a higher high outside of this range right here. Just speaks to the fact that although yes, rates are high right now, people aren't flocking to them like they were over here and over here. This, of course, is the TLT versus the QQQ. It's the same thing as the last chart we looked at versus the SPY, just indicating once again that people do prefer to be in technology, which is a risk asset right now, versus the TLT, classically more defensive. If we take a look at something like the HYG for our junk bonds, notice that we did produce a higher high in the HYG along with equities. That does strike me as a positive relationship. We haven't really seen these things playing nicely together. This is the first sign of that we've gotten in quite some time. Don't get me wrong, we still are divergent with from here to here lower highs and from from here to here, higher highs, but that alone is not enough to short the S&P 500. If you want to remain skeptical, that's totally your prerogative, and I wouldn't call you crazy for that, but we are starting to see these things start to marry up nicely once again. I also want to take a look at Bitcoin this week, simply noting what was going on with the SEC, Coinbase, and Binance. You'll note that we had a strong gap down to sort of start the week, and we rallied back towards this gravity point close to 27,000, just for, to round off there. What would this indicate, right? People don't really care about the regulation. People don't really care about what's going on between Coinbase, the SEC, Binance, and the sort of implications of that investigation. People just know that, hey, Bitcoin seems to be doing all right. It's a risk asset, and this would speak to the bullish nature of markets down below. Once again, I want to be very, very clear, since we haven't covered it in a while. This is not a one-to-one relationship, but it does support more of a risk appetite for overall financial risk as opposed to a lack. When it comes to market breadth, we are also seeing some improvements here. Now, it needs to continue to improve, but we are moving in the proper direction. We're getting better, not worse. Above the zero line out of new highs versus lows. If we take a look at the SPX A200R stocks in the S&P trading above their 200 SMA, this is a weekly time frame, over the 50% mark now. Again, a step in the right direction, not the wrong direction. And the biggest divergence that we were noting in previous videos breadth-wise was the SPX A50R stocks over the 50 SMA in the S&P 500. This is a daily time frame chart. Just remember that this is ultimately the top of this range back here. We haven't made a higher high, but we now have an equal high. We pulled back on Friday, but the equal high, once again, is a step in the right direction. Things are getting better breadth-wise, not worse. It doesn't mean that we're all of a sudden bullish the market. The market needs to go to all-time highs, but things are improving. They are not deteriorating here. We can also say something about the RSP that counters this narrative, so don't worry, we will remain balanced. If the RSP rejects at this level of resistance here and we pull back, of course that spells trouble for your weighted S&P down below. This is clearly still divergent. This is the equivalent of this breakout range right here, and if we reject that, it doesn't speak well for the odds of the S&P weighted continuing down below. A different picture could also be the not RSP, we're just on the RSP. The Dow versus the Dow transports, right? So industrials versus transports down below. This line represents the sort of equivalent area, so to speak, on the market. We still have a decent amount of space above, One thing that you want to carry forward here is if this breaks out of its flag, which it looks like it's starting to do as of Friday's close, and this is pulling back, big red flag for the market. You probably wouldn't want to trust any breakouts that you're seeing. These want to move in tandem and not necessarily divergent from one another. The only saving grace would be if the Dow transports find a higher low off the top of this prior breakout point as this is unfolding. That would be the saving grace, but beyond that, be really skeptical. So watching transports closely, and the level to watch would be 14,120. 14,120. If we're underneath 14,120, starts to become a red flag if industrials are making the move higher. VIX volatility, a brand new lowest low that we've seen since the sickness oh so long ago. And anybody who's telling you that the market must crash because VIX always spikes from support down below and it can't be at these unsustainable levels, they simply do not understand how this instrument works. If instead someone told you, hey, I took a look behind the curtain at the VVIX and I'm actually pretty concerned with this little uptick into the end of last week as the markets were also moving higher, that starts to make much more sense. Volatility of volatility did tick higher. We haven't recaptured the trend line breakdown here. You can see we may be coming in for a break, retest, and lower high, but it just speaks to the fact that some folks out there are likely concerned about the outcome of CPI, PPI, and the FOMC in the coming weeks worth of trade. If this really starts to accelerate and we get above 103, I would put my thinking cap on and say, hey, that probably spells red flag for equities down below. Keep an eye on it, but it's not because the VIX itself is floored down below at these lower levels. Let's take a look at the volatility futures. These are still working themselves into a contango. If you're not a believer in 30-day options anymore because 0 DTEs broke everything, there's your 9 versus 30. It's the closest we can get, and it's still underneath the zero line here as well, indicating a contango. One-day VIX does not have enough data yet, but it did make a small imprint higher as the markets pulled back on Friday. Not overly concerning just yet, nowhere near some of these highs from in the past. And then lastly, we've been talking about the skew in the past couple of videos. A huge, more significant higher high was produced, but if you just draw this out to the left and pair this up with what was going on in the market here, market continued to move higher for quite some time. If you do this, absolutely, it did lead to something down the line, but before that, it took how many months? We're looking at a what was that be? July until the early parts of or midpoint of September before that market actually moved lower. And then the same thing back here. We of course know that this well extended. The market continued for quite some time time before making that downdraft for all of 2022. All it says is that people are concerned with tail risk right now beyond 30 days in the market. Doesn't mean that the black swan has to come true. It's worth keeping an eye on, but I wouldn't short the market just because skew is elevated. QQQ weekly time frame chart certainly did produce more of a hammer-esque type candle, but let's not fool ourselves. We are unchanged on the week. The biggest takeaway here is just that buyers step up at the lows of the weekly bar and are able to close prices in the upper third of the weekly bar. In terms of location on the bar-to-bar count, we have a higher low as well as a higher high. And in the overall trend sequence on the weekly, we've got lows, higher lows, higher lows, higher lows, highs, higher highs, higher highs. We've been calling these Superman higher highs. Do not step in front of the freight train. Do not step in front of Superman. It would be unreasonable to deny that momentum is kind of slowing down. These two bars are clearly different than the prior two bars, but the weekly trend firmly remains in the upward direction. A line in the sand for a pullback would be just above the breakout point from here, the weekly bull flag that led to this move in the first place. That level is roughly 320. If we come in with the Fibonacci's from the October low to this most recent high, lo and behold, your 38.2 retracement is right at that magic spot, 320. It gets better. Let's go ahead and throw on the volume profile on the weekly. Where's the highest volume node in recent trade history? 320. So I'm not calling for markets to pull back all the way to that level. All I'm saying is that if markets do pull back, which is completely reasonable given the slowdown in momentum, given where we are in the trend sequence, we can easily find a higher low above. Something that may be a bit more pertinent and relevant to this week's analysis could be somewhere in here closer to 340. We'll check out the level on the daily chart in just a moment. Overhead resistance also pairing nicely with structure. This was structure as well, right? That level is going to be closer to 366. We'll also see that on the daily right now. Let's take a look at the daily time frame chart and see what's going on with our levels, expected move, and any patterns that are in force. So expected move does strike me as bullish for all the same reasons as the SPY expected move does. The upper bound is roughly 363. The lower bound is right around 346 even. Notice that this is an equal low. This is your gatekeeper for the breakdown potentially that may unfold, right? I'm not calling for a big breakdown, but if we do find ourselves underneath 346.75 and the lower bound of the expected move, we know that we have incredibly thin structure from here, and there is that 340 we were just roughly referencing on the weekly time frame chart as a high volume node. We do have an inverted hammer that closed on Friday, and we did not produce a higher high outside of the range on Friday, unlike what we saw in the SPY. So breaking down under Friday's low just keeps us in flag consolidation and balance here. That level is 350, and we should look for the rotation to the lows here at 349. Let's see that on the hourly time frame chart and just sort of evaluate the structure from this perspective. If we go ahead and look at it like this, a little bit more centered, there's your lower high that we referred to in the SPY as well. So keeping an open mind to being neutral here, break and retest lower highs under 350 are tradable back down towards these lows at 349. We will reevaluate when and if we get there. Again, this is the bigger threat in the downward direction because we can see that thin structure. If markets remain here and take a higher low above 355.50, that's your lower high from the Friday afternoon session. So consolidation, break higher low. It's all eyes on the overhead gap that starts filling at 357.64, closes at 359.88, and then overhead we have the upper bound of the expected move 363 that we referred to, and then on the weekly, remember that we were roughly looking at 366.50. The structural element is actually at 368.25. Let's go ahead and throw on our VWAP just like we did for the SPY. Notice that it's anchored to the gap and go from back here. If we pull back, if we do get this lower high, just building the case that 349 should be thought of as support, and you shouldn't be overly aggressive on the downside here until we can get a larger something that looks like this and a potential for a daily trend change. As of right now, everything still stacks up as being more of a bullish data point than a bearish data point, and we can confirm that as well with the fibs from the low up to the high. Your 38.2 is stacked up beautifully right around that 349 area as well. Let's take a look at our market internals for the Qs. Apologies for not having this preloaded, but we do have inflows on the week. Again, nothing significant. It's not like we were breaching 500 million. We're still in consolidation, but this is bullish consolidation, not bearish consolidation. We simply had net inflows on the week. Same thing with the advanced decline line, and we can say similar things about the cumulative tick. Remember that we were skeptical of the Wednesday breakdown, right? This is where the aggressive breakdown happened, and the tick was not confirming that whatsoever. As we saw some bullish activity up towards the top of the range, the tick is once again not really confirming here. So I wouldn't be looking for just a huge break in the upward direction. The internals aren't really confirming that, but the consolidation thus far is bullish. It does have a bullish edge. Perhaps breaking down underneath Friday's low does lead to a little bit more rotation in the balance balance range that we were just looking at on the hourly chart, right? There's that breakdown. Something like this would not totally be unreasonable. Bigger bearish outcomes happen here. That's where the concern really starts to step in. That would be breaching the 2 weekly lows that we saw on the weekly time frame chart as well. IWM Russell 2000 and the small caps weekly structure looks much different than everything else that we've seen thus far. Stronger green body, but we do have a low confidence upper and lower wick attached to that green body. But nonetheless, the close is clearly well above the opening print. On the bar to bar count, we have ourselves a higher low as well as a definitive higher high, and we have doubled the range in terms of here and here. So we're home, we've hit the target, we're at the banking crisis breakdown area. One thing that's clearly different though is that we are not in a glaring weekly uptrend. If anything, this is really neutral and sideways and consolidating on the weekly time frame chart, monthly time frame chart. So from that perspective, not nearly as strong in small caps. Are they playing catch up? Perhaps. The one level that you would want to see hold on any pullbacks would just be the top of the range, much closer to 180 on the weekly time frame. If we come in with the Fibonacci's from the low up to the high, notice that your 38.2 would keep you above the top of that consolidation range. That would be bullish on this time frame. Let's take a quick peek at our volume profile. Actually, as a matter of fact, the anchored VWAPs are much more in play out of the IWM. Notice that we are still rejecting that all-time high anchored VWAP. We have broken out over, though, the October low anchored VWAP. That is noteworthy. Let's take a look at the volume profile now. Let's not get ahead of ourselves. We know that we're sitting on a strong base of volume support, and there's a massive overhead low volume void until we come well above towards 225. Not making the call again that we go there in the coming weeks worth of trade, just pointing out volume-wise that there's not a lot to stop us overhead. The next structural elements that we should really be focusing on are much closer to 192, the open of the banking crisis candle high. Let's move on down to a daily time frame chart and evaluate what's going on from that perspective. Expected move, all the same stuff we're always looking at here. If we take a closer look, expected move is clearly bullish. The breakout on the day-to-day basis in the IWM has been much stronger, right? Especially over the last week or so. So big gap and go kicks us off. We break the weekly balance range and we see continuation early on last week. That was Tuesday, I believe. So a little bit of consolidation, bull flag consolidation, and we're well above the single prints that unlock the thin structure underneath us. So the daily time frame chart is incredibly bullish. Anything that continues to consolidate here, you're looking for the break up and over 186.75 to achieve 190. We saw that as structural resistance on the weekly, and then that 190, 150, 192 top, the open of the banking crisis candle high. Let's take a look at the hourly time frame chart. This is where we can start to see that, of course, this is where the thin structure and the stronger breakdown will unfold. So if you're a market bear in small caps, you got to be patient in the IWM until at least 183.50 is tested. One thing that I found extremely interesting is that on Friday, when the liquidation break takes place, big momentum bar on the hourly time frame chart there, and then it immediately stops and goes sideways for the remainder of the day. The sellers do not continue to hammer this and even attempt to get back down towards the single prints that unlock the thin structure here, down towards that 180, what's the level, 180.50s, give or take. That's the lower edge of the weekly expected move as well. I also want to throw on the anchored VWAP from the breakout point, so bear with me as I edit this study to get it to the proper anchor. It's going to be 2023.0601. There we are. And now we have the anchor properly set to where the gap, or I shouldn't say gap, but this is the first indication of squeeze. Remember that strong hourly bar? This goes, consolidates, gap and go after that. Notice anchored VWAP over time will start to migrate and creep slowly higher. It probably won't be there on Monday, but maybe Tuesday to coincide with support at the start of the single prints. 183.50 is your most important level out of IWM into the coming weeks worth of trade for all of these reasons. I haven't checked the fibs, but let's do it together. Here we go. Notice that that would clearly be a pullback well above the 38.2. This is suggesting that we could go lower. I, of course, would not want to see that just based on structure. Fibonacci's are nice when they provide confluence, but structure will always reign supreme. If you've made it to this point in the video, I just want to say thank you. Anyone who's made it this far is already subscribed and likely does not need a reminder to subscribe. See what I did there? Apple is up first for the core list of companies. What's going on here? Certainly a small inverted hammer on the Friday session. I would not be surprised at all to see consolidation in here. Wait for the CPI news. If it's good news, break 182 higher lows above are good to go for all-time highs 184.50 and blue sky territories beyond that. I would not look to short Apple on a breakdown of 179.50. The consolidation lows I'll show you on the hourly hourly in just a second. I would wait for the lower high underneath, and then it's all eyes on this top of the gap at 176.75. Here's the hourly to illustrate that structure and why I would not necessarily short this, right? There it is. There it is. You would want to wait for the lower high underneath before being overly aggressive. Anything that's kind of in here is neutral, willing to go with breaks over 182. Next up is Netflix. Let's go back to the daily time frame chart. Gap and somewhat hold on the Friday session. So because we do have a partial gap fill, that's always going to be indicative of the sellers failing to do their job completely in the case of a gap up. So if we open in Friday's range on Monday and take out that high, a break of 427.75 gets interesting. There is some room to run overhead towards 448.25 because we have a consolidation phase before this, because we already have a fake break. I would say that any sellers who are still in this should start to squeeze out as the move unfolds. The only time I would look to go short in Netflix is if we can breach this flush point at the bottom of the consolidation, 397.50, and produce a lower high underneath. Needs to do this before we start going the other way. Next up is going to be Tesla, also another gap candidate from the Friday session. Hopefully you were tuning into the pre-market live. We said, might not make sense to chase this, and unfortunately the structure was vertical here. The gap up does not help that by any stretch of the imagination. Wait, let some structure build out. We don't really have levels to trade off of definitively. The most interesting thing that I could start to imagine is because we have an intraday lower high, just like the broad market, a flush of the low gets interesting for a gap close. Under 242 closes at 235.25. You are shorting something that is incredibly strong, so make sure you have a clear stop loss defined that's offering good risk reward before engaging in that type of trade. Upside is a bit limited here. Even if we break Friday's range for continuation, target or sort of resistance is 257.30 coming from prior structure. Let's take a look at Google. What's going on over here? This is a strong short candidate, noting that we did have a 100% retracement, and we've already found the lower high. A flush of these lows here at 122 get interesting for continuation in the downward direction. Here's the hourly time frame chart. Clear as day, bear flag, break 122, targets back here 120.15, then you can continue to walk them down. 117.50 would be next. It's got to break first, right? Don't short this if we're just in the midpoint of this range. Wait for the break of 122. But because the consolidation is already in play, I wouldn't necessarily feel like you have to wait for the lower high underneath in this case. For buyers, right, it's neutral in the range. Got to prove it now. Got to prove it with the higher low over 124.75. Next up is Metaverse. What's going on with the fantasy land over here? Pretty interesting. I would say that this is a pretty interesting chart. Let's actually best explain this one on the hourly, right? Notice the double top is almost so precise that if it's tested again, it should break, and we have thin structure through this breakdown. The issue is, though, that you're just testing overhead supply at 270.50. So clear opportunity for a lower high there. That would be something that's definitely scalpable in the upward direction, but if you're a longer term trader using these videos, just make note that a daily lower high could be produced under 270.50 if these upper wicks are not already the lower high that's in place. If you're looking for the short based on the head and shoulders pattern, that's fine. Just remember that it's not a head and shoulders until it is. That's under 260. Next up is NVIDIA. This is still in no man's land. Let's just keep it on the hourly time frame chart. It tried intraday to make a definitive move back over that 389.75. Just didn't hold up into the close. Now we're chopping around. The structure here is also not that well defined. I think that, your Apple structure looks better. Your Meta structure that we just saw looks better. Google looks better. This falls pretty low on the tier list of things that'll be a focus early on in the week, and hopefully you can see why. We're chopping around the midpoint of a loosely defined range. Next up is Microsoft. What's going on with Softy? We're just keeping this on an hourly time frame chart. Higher lows, right? Higher lows are interesting here, especially holding into the close at 326.50. If you're looking at a daily chart, it's a little bit concerning with that large upper wick, but I would be willing to give this one the benefit of the doubt if it wants to stay above. If it wants to stay above, you've got to look below and fail. On this range here, you're technically holding up over the neckline of the double bottom, 1 and 2. That gets interesting, right? So 326.50, a little bit misleading if you're only looking at the daily time frame. Of course, shorts are on the table if we take out the lows of that complete pattern at 323.75. Gap is on the table as a target, 320 down to 316.50. Last but certainly not least, we've got the mini beast inside bars. Notice Wednesday is a large bearish bar inside from there, producing large upper wicks. Let's take a closer peek at the hourly time frame chart. Flush point, that would be the main focus early on in the week, especially with the intraday lower high on Friday. 123.25 breakdown there should lead you to the equal low, 121.25. Any consolidation in the range is exactly that. It's neutral, it's choppy. Buyers have something going on only with a higher low over 125.50. And last but certainly not least, a couple of trade ideas to send you on your way. First up on the chopping block is BA for Boeing, and we're starting on a weekly time frame chart. You can clearly see a strong period of consolidation. If you add in a little bit of context, it turns into a weekly bull flag, and the location is impressive as well. All of this consolidation is well above the neckline of the double bottom reversal here. Some important notes is that we did take out the prior weekly low. We'll see that nuance on the daily chart in just a moment, but we've closed at the top of the balance range here. A measured move or a range double brings us closer to prior structure from in the past at 237. Basically, we are trading for upside outcomes here. The more aggressive measured move is stacking the flagpole on top. That's kind of unreasonable for 1 week's worth of trade. Let's take a look at the daily time frame where I can illustrate that sweep of the low a little bit more clearly. So there's the sweep of the prior weekly low. The reason that that is significant is because if the sellers were going to make a stand, that's where they were going to rotate towards the bottom end of the range. It simply did not happen, even with the bad news catalyst about the delay in production of the Dreamliners. Now on the daily time frame chart, Friday is an inside bar producing a 3-bar play. If we take out 218.50, we are looking to trade for those upside outcomes. Conservative traders can wait for a break, retest, and higher low formed above 218.50 before getting involved. There's plenty of range to trade for in the upward direction. Next up, last but not least, we certainly have DVN for Devon Energy, and this is a double bottom, but on a smaller time frame like the daily. You can see we have a 3-bar balance in play here. Friday is an inside bar, 3 perfectly equal highs in need of some repair. If we take out 50.43, the rotation should be to here where this most recent leg lower came from at 51.75. Keep in mind, if we just drag this off to the left, it is the neckline of this double bottom on your screen. Not interested if we start taking out this level in here, closer to 49 even. That's going to wrap up today's episode of the Weekly Watch List. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a simple thumbs up. I hope to see you all at 8:15 on Monday morning for the pre-market prep, and enjoy what's left of your weekend. Have a green trading week.